It's an important enough subject that I would like to give you an overview on video, but I'm going to place a link to a very good article that we have on our website that thoroughly explains the foreign tax credit. In short, the United States, they actually go through a lot of efforts to make sure that their citizens living abroad are not subject to double taxation. That is not their intent. For those of you out there that question the number of forms, the filing requirements, the penalties, etc., know that these are information efforts that the IRS is doing. They want to have as much information as they can from their citizens living abroad, but their intent is not to double tax or their citizens to be subject to double tax. So the foreign tax credit is one of the avenues, one of the tools they use for that not to happen. When you read the description of the foreign tax credit, what it says is that it's intended to be a dollar-for-dollar credit for any taxes that you paid to a foreign jurisdiction to be used against your U.S. taxes due. Now, dollar for dollar sounds beautiful, but there is a calculation to that. For example, if you're earning over $100,000 a year and in your particular situation you want to take advantage of both the foreign earned income exclusion and the foreign tax credit, then when it comes to calculating the foreign tax credit, it's going to disallow proportionally the taxes that were paid to the foreign jurisdiction, taking into account the amounts that were excluded for U.S. tax purpose. The reasoning behind that is we're not taxing you on those $92,900, hence we're not going to give you credit for any taxes that you paid for those amounts. But in short, if you live in a foreign country and that foreign country's effective tax rate is 20%, then when you prepare your U.S. tax returns, your effective tax rate is 18%. That means that as it relates to U.S. taxes, you're going to have 2 points of taxes that are going to be available for you to use. Carry it back 1 year, carry it forward 10 years. Let's look at the alternate scenario. The foreign country's effective tax rate is 18% and the U.S. effective tax rate is 20%. You're going to pay the difference to the U.S. You're always going to end up paying the higher tax rate. You're not going to be double taxed. If you look at the calculation on the foreign tax credit, it does mitigate double taxation, but you're going to end up paying the higher jurisdiction amount.